There is a surcharge sitting inside your Medicare premium right now that is based on income you are no longer earning. Not last year's income, not the year before that. Income from 2 years ago. Income from when you were still working, still at the peak of your earning years, still pulling in a salary that has nothing to do with the retirement income you are actually living on today. And Medicare is using that old number, from that ghost of your last working year, to calculate how much extra you pay every single month in 2026. And here is the part that should make every retiree in America furious. There's a form that fixes this. One form. It takes 15 minutes to complete. It sits on the government's own website. And when you file it correctly, Medicare recalculates your premium based on what you are actually earning right now instead of what you were earning 2 years ago. I have seen that single form save retirees between $1,000 and nearly $7,000 a year per person every year until their income situation changes. Almost nobody files it. Not because it is hard, not because it requires a lawyer or an accountant or any professional help at all, because almost nobody knows it exists, because the agency that collects the surcharge has zero financial incentive to tell you about the form that eliminates it, because the letter that arrives in your mailbox announcing the surcharge does not mention the appeal option in plain English. It mentions it buried in fine print at the bottom of a 4-page notice in a font that my clients regularly describe as requiring a magnifying glass. In the next 20 minutes, I'm going to walk you through exactly what this surcharge is, exactly how Medicare calculates it using income that may be completely irrelevant to your current financial situation, exactly who is getting hit by it right now without realizing there's anything they can do about it, and exactly how to file the form that makes it stop. I'm also going to tell you about 3 additional moves that can keep this surcharge from coming back year after year, because filing the form once is not the end of the story. Understanding how Medicare looks at your income and planning around that look back is how you protect yourself permanently. But before I get into any of that, I want to tell you about a client of mine. I am going to call her Patricia. Patricia is 69 years old. She lives outside of Charlotte, North Carolina. She spent 32 years as a human resources director for a regional hospital system. She retired in early 2024. Her final year salary in 2023 was $187,000. It was the highest she had ever earned. She had worked her way up over 3 decades, and her last 2 years were her peak. When Patricia retired, her income dropped immediately and dramatically. Her Social Security benefit is $2,340 a month. She has a small pension from the hospital system, $1,100 a month. She draws about $18,000 a year from her IRA to cover what the other 2 sources do not. Her total retirement income is roughly $57,000 a year, less than a third of what she was earning the year she left. Patricia enrolled in Medicare in late 2024. A few months later, she received a letter. The letter informed her that her 2026 Medicare Part B and Part D premiums would include an income-related monthly adjustment. The letter used that phrase, income-related monthly adjustment. It did not say surcharge. It did not say penalty. It said adjustment. The adjustment amounted to $460 a month, on top of her standard Medicare premium. Patricia called me because she assumed there had been a mistake. How could Medicare be charging her a high-income surcharge when she was living on $57,000 a year? The answer I gave her is the same answer I'm about to give you. And it is the answer that makes this surcharge one of the most punishing and least understood costs in all of American retirement. Medicare does not look at what you are earning now. Medicare looks at your tax return from 2 years ago. That is the rule. It is called the 2-year look back. When Medicare sets your premium for 2026, it is using the income you reported on your 2024 tax return. And Patricia's 2024 tax return showed $187,000 in income, the last full year she worked, the year before she retired. So in 2026, Patricia is living on $57,000 and paying a Medicare surcharge calculated on $187,000. She is being charged for income she no longer has. She is paying a premium she no longer qualifies for. And the form that fixes it has been sitting on the Social Security Administration's website the entire time. That form is called the SSA-44, and that is what the rest of this video is about. My name is Marcus Steele. I am an enrolled agent, federally licensed to represent taxpayers directly in front of the Internal Revenue Service. I have worked with retirees on Medicare costs, Social Security taxation, and retirement income planning for more than 20 years. And the pattern I see that costs people the most money over and over again is not complicated tax strategy. It is not a clever scheme the wealthy use that ordinary people cannot access. It is simply this. Retirees receiving bills they do not owe, for amounts they do not qualify for, because nobody ever told them they could dispute it. Patricia should not be paying that surcharge. Gerald, who I talked about in a previous video, should not have been paying taxes on 85% of his Social Security. The rules are written in a way that assumes you'll pay whatever arrives in the mail. Most retirees do exactly that, and the government counts on it. Let me explain the surcharge from the beginning, because you cannot fight something you do not fully understand. The surcharge has a name. It is called IRMAA. That stands for Income-Related Monthly Adjustment Amount. It is an extra charge added on top of your standard Medicare Part B and Part D premiums once your income crosses certain thresholds. It exists because Congress decided in 2003 that higher income Medicare beneficiaries should pay more for their coverage. In 2026, the standard Medicare Part B premium is $185 a month. If your income is below $106,000 as a single filer or below $212,000 as a married couple filing jointly, you pay the standard premium, nothing extra. But the moment your income crosses those thresholds, the surcharge begins, and it climbs in tiers. For a single filer earning between $106,000 and $133,000, the surcharge adds roughly $74 a month to your Part B premium. Between $133,000 and $167,000, it adds $187 a month. Between $167,000 and $200,000, it adds $297 a month. Between $200,000 and $500,000, it adds $374 a month. Above $500,000, it adds $443 a month. And those are just the Part B numbers. There are separate Part D surcharges stacked on top of those. At the highest income tier, the total IRMAA surcharge for Part B and Part D combined is nearly $578 a month per person. Nearly $7,000 a year per person. Meaning, a married couple at the highest income tier is paying close to $14,000 a year in Medicare surcharges alone. And now here is the trap. The income Medicare uses to place you in those tiers is not your current income. It is your MAGI, your modified adjusted gross income, from your tax return 2 years ago. For 2026, Medicare is looking at your 2024 tax return. That is the most recent full-year return available when Medicare sets premiums in late 2025, which means if you retired in 2024, the way Patricia did, your 2026 Medicare premium is based on income that ended when you walked out the door. If your spouse passed away in 2024 and your household income dropped by half, your 2026 premium is still based on the two-income number. If you sold a business in 2024 and that sale created a one-time spike in your income that will never happen again, your 2026 premium reflects that spike as though it were permanent. The surcharge is real. The income it is based on is gone. And without the form, you keep paying. Now let me tell you exactly who this is hitting right now, because I want to be direct about both groups of retirees watching this. If you are a lower to middle income retiree who never earned above the thresholds in your career, this specific surcharge is probably not hitting you. Your income was always below the line. Your 2024 tax return reflects that. You are paying the standard premium, and the IRMAA is not your problem today. But stay with me, because the income management strategies at the end of this video can protect you from crossing the threshold in future years as your IRA distributions grow. If you are a comfortable retiree who was earning a solid salary in the years before you retired, the 2-year look back is almost certainly hitting you. If your working income exceeded $106,000 as a single person or $212,000 as a couple, and you retired in 2024 or 2025, you are paying a surcharge right now based on income that is over. And you are probably paying it without knowing the form exists that can make it stop. This is the group that gets ignored in most retirement content. The low-income focused videos tell them the good stuff is not for them. The wealth management content assumes they have an advisor who has already handled this. Most of them do not have an advisor who has handled it. Most of them are sitting on a surcharge that could be eliminated in 15 minutes and paying it month after month after month because nobody explained the form. That is who this video is for. Both groups, different reasons, same information. Let me walk you through exactly how the form works. The form is called the SSA-44. The full name is Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. You can find it by going to ssa.gov and searching SSA-44. It is a free download. You do not need to pay anyone to get it. You do not need to schedule an appointment to file it, though you can file it in person if you prefer. You can mail it or fax it directly to your local Social Security Administration office. The form allows you to request that Medicare recalculate your surcharge based on a more recent year's income rather than the 2-year look-back year. To qualify, you must have experienced what the Social Security Administration calls a life-changing event. The list of qualifying events is broader than most people realize. Retirement is on the list, Specifically, stopping work or reducing hours. That covers the retiree who left a job in 2024 and whose income dropped dramatically. The death of a spouse is on the list. A divorce is on the list. A reduction in pension income is on the list. The loss of income-producing property due to a disaster is on the list. The cessation of certain employer benefit programs is on the list. And then there's the one that most people never see. The Social Security Administration calls it Event Number 8. It is described as loss of income-producing property, which in practice has been interpreted to cover situations where income dropped significantly for reasons that fall outside the other specific categories. This catch-all has been used successfully by retirees who had a one-time spike in income from a business sale, a large Roth conversion, or an unusual distribution that will not repeat. Patricia qualified under the retirement category. The moment she stopped working in 2024 and her income fell from $187,000 to $57,000, she had a qualifying life-changing event. She filed the SSA-44 with documentation showing her retirement date, a letter from her former employer confirming her last day, and her current year income estimate. Medicare accepted the appeal. Her 2026 premium was recalculated based on her actual retirement income of $57,000. Her surcharge was eliminated entirely. She went from paying $462 a month in extra premiums to paying the standard rate. That is $5,144 back in her pocket in 1 year from one form. Let me walk you through the documentation you need to file because this is where people get tripped up and delays happen. If your qualifying event is retirement, you need two things. First, documentation of the event itself. A letter from your former employer stating your retirement date, or a letter from the plan administrator of any pension or retirement plan showing when benefits began, works. If you are self-employed, a signed statement from a licensed tax professional attesting that you ceased self-employment activity and the date it occurred is acceptable. Second, you need an estimate of your current year income. This does not have to be an exact number. It can be a projection based on your expected Social Security benefit, your pension, your planned IRA withdrawals, and any other income sources. The Social Security Administration uses this estimate to determine which IRMAA tier, if any, your current income places you in. If your qualifying event was the death of a spouse, you need the death certificate and an estimate of your current income as a single filer rather than the prior joint return income. If you are appealing based on a one-time income spike, you need documentation showing the nature of the spike, the year it occurred, and evidence that the income was non-recurring. A letter from a CPA or enrolled agent is often the most effective way to document this category. The Social Security Administration typically processes SSA-44 appeals within 30 to 90 days. If your appeal is approved, the adjustment is retroactive to the beginning of the calendar year or to the date of the qualifying event, whichever is appropriate. If you have been paying the higher premium for months while the appeal processed, you receive a refund for the excess amount. If your first appeal is denied, you have additional options. You can request a hearing with the Office of Medicare Hearings and Appeals within 60 days of the denial. You can escalate to the Medicare Appeals Council. In cases where the amount is significant, you can file in federal district court. Most appeals at the SSA-44 level are resolved without escalation, but knowing the process exists is important because some denials are simply administrative errors that get corrected at the next level. Now, let me talk about what happens after you fix the current year, because filing the SSA-44 is the immediate solution, but it is not the permanent one. Your income situation changes year to year. The look-back rule means every year's premium is based on income from 2 years earlier, which means the moves you make today affect your Medicare premium in 2 years. And the moves you make in 2 years affect the premium the year after that. The retirees who manage this well are the ones who understand that Medicare premium planning is a continuous activity, not a one-time fix. Here are the 3 moves that protect you going forward. The first one is managing your IRA withdrawal size relative to the IRMAA thresholds. Every dollar you pull from a traditional IRA adds to your MAGI, and MAGI is the number Medicare looks at. A retiree who needs $50,000 from their IRA to cover living expenses may be below the IRMAA threshold. A retiree who decides to take an extra $60,000 from their IRA to renovate a kitchen might cross the first tier and add nearly $900 a year to their Medicare premium for the next 2 years. Not because their retirement income fundamentally changed. Because of one decision in 1 year. That does not mean never take the withdrawal. It means know the threshold before you decide the amount. In 2026, the IRMAA cliff for a single filer begins at $106,000 in MAGI. That is your number to watch. If your income is approaching that threshold, a financial decision that pushes you over the line triggers a Medicare premium increase 2 years from now. Knowing the number means you can make the decision with full information instead of discovering the consequence 2 years later on a Medicare premium notice. The second move is the Roth conversion timing strategy. For retirees between the ages of 65 and 73, the years before required minimum distributions begin. Converting a portion of a traditional IRA to a Roth IRA each year can reduce future magi permanently. The conversion itself adds to your income in the year it happens, which is a real cost. But once the money is in the Roth, it grows tax-free, and distributions from a Roth IRA do not appear in magi at all. Every dollar converted out of the traditional IRA is a dollar that will never push you over the IRMAA threshold in future years. Done carefully over several years, staying below the threshold each time, this strategy can dramatically reduce the lifetime Medicare surcharge exposure for a retiree with a significant traditional IRA balance. The third move is the qualified charitable distribution, and this one applies specifically to retirees who are 70 and a half or older, give to charity in any amount, and have money in a traditional IRA. A qualified charitable distribution allows you to send money directly from your IRA to a qualifying charity, up to $111,000 per person in 2026. And the key point for Medicare purposes is this, that money never enters your magi. It is excluded from income entirely, not deducted from income, excluded, which means every dollar you give through a qualified charitable distribution, instead of writing a check from a bank account, is a dollar that does not count toward the IRMAA threshold. A retiree who gives $12,000 to church every year and is near the first IRMAA threshold can use the qualified charitable distribution to keep that $12,000 out of their magi entirely. If that $12,000 would have pushed them over the threshold, avoiding the first IRMAA tier saves them nearly $900 a year in Medicare surcharges, on top of the fact that the giving itself is now tax advantaged in a way it was not before. Most retirees who give to charity write a check from a bank account, get no tax benefit because they take the standard deduction, and never realize the qualified charitable distribution option exists. The QCD changes the entire math of charitable giving for anyone over 70 and a half with an IRA, and it directly protects your Medicare premium at the same time. Let me tell you what happened with Patricia after she filed the SSA-44 and got her premium reduced. She called me again about 8 months later. She was reviewing her finances for the following year, and she had just taken a larger than usual IRA withdrawal that year to help her daughter with a down payment on a house. The withdrawal was $45,000. On top of her other income, her total magi for that year was going to be around $121,000, just above the first IRMAA tier. She was going to land in a surcharge again, not the massive one from before, but a real one, about $74 a month extra, nearly $900 a year. We looked at the timing. She still had 2 months left in the calendar year. She had already filed the large withdrawal, so we could not undo that, but she gave $8,000 a year to her church. We moved that, giving to a qualified charitable distribution from her IRA before December 31st. That $8,000 came out of her magi entirely. Her total magi dropped from $121,000 to $113,000, still above the threshold, but barely. We also looked at whether she had any tax loss harvesting opportunities in her brokerage account that could offset some of the income. She had one position that had declined in value. We sold it for a $6,500 loss. Her magi dropped to $106,500, still just above the threshold. We were $501 above the first IRMAA cliff. There was nothing else to do in time. She was going to pay the surcharge for those 2 years, and she said something to me after that conversation that I think about every time I sit down to make a video like this one. She said, "I wish I had known these numbers 2 months ago when I made the IRA decision. I would have taken $46,000 instead of $45,000 and used the extra $1,000 for something else. I would have moved my charitable giving to the QCD before the withdrawal. I would have stayed under." She was $501 over a threshold that cost her $976 across 2 years of surcharges. One conversation in October before the withdrawal would have saved her the entire amount. That is the whole lesson. The surcharge is real. The form that fixes it after the fact is real. But the planning that prevents it from happening in the first place is what separates the retirees who pay thousands in unnecessary Medicare costs from the ones who do not. You now know the form. You know how to file it. You know the 3 moves that reduce your exposure going forward. The only thing left to decide is whether you act on it. Before I close, I want to give you something to take with you. I put together a free checklist, my 2026 Retirement Tax Protection Checklist. It covers the full IRMAA threshold table for 2026, the SSA-44 filing instructions step by step, the documentation checklist for each qualifying life-changing event, the Roth conversion window strategy, the qualified charitable distribution rules and limits, and the 5 other Medicare and tax moves that most retirees miss every single year. Every item includes the form number, the deadline, and exactly what to do. No guesswork. To get it, go to marcusgravestacks.com/checklist. The link is also in the description below. Print it out and go through it before the end of this year, because the decisions you make before December 31st are the ones that protect your 2028 Medicare premium, and the decisions you make today are the ones that protect your 2026 premium right now. Here is what I want to leave you with. Medicare sends you a premium notice. The notice includes a surcharge. The notice mentions in fine print that you may have options. It does not call the form by name in plain English on the front page. It does not say, if your income has dropped since retirement, file this form and we will recalculate. It does not say, you have 15 minutes of paperwork standing between you and thousands of dollars a year. It says income-related monthly adjustment, and it tells you what you owe. And the system is built on the assumption that you will simply pay it. Patricia did not simply pay it. She filed the form. She got her premium reduced by $544 a year. And then she came back 8 months later, and we built the plan that prevents the surcharge from coming back. That is the whole game. Know the form, file the form, then build the plan that makes the form unnecessary. Every retiree watching this who retired in the last 2 years, who lost a spouse in the last 2 years, who had a one-time income spike in 2024 that will not repeat, needs to look at their Medicare premium notice and ask one question. Is this based on income I am still earning? If the answer is no, the SSA-44 is waiting. Send this video to one person you know who is on Medicare and recently retired, or recently lost a spouse. The odds are very good. They are paying a surcharge right now based on income that is gone. And one share from you today could put thousands of dollars back in their pocket this year. That is what this channel is here to do. I will see you in the next one.